Jake is not broke. He has a job. He has savings. He even has a brokerage account. He is doing more than most people his age, but over the last 5 years, Jake has quietly lost tens of thousands of dollars. Not from a scam, not from bad luck, not from a market crash, from 5 investing mistakes that most people make without ever realizing it. The worst part? Every single one of them feels like the smart thing to do at the time. This is Jake's story, and there is a very good chance it is yours too. Before we get into it, if you want honest money breakdowns that show you exactly what is working and what is quietly draining your wealth, subscribe right now and turn on notifications. This channel runs the real numbers with no agenda. Let us get into it. Jake is 28 years old. He earns $60,000 a year. He saves $400 a month and puts it into his brokerage account. He reads financial news. He watches YouTube videos about investing. He thinks he's doing everything right. He is not. Here are the 5 mistakes Jake made and what he finally did to fix them. Mistake 1. Waiting for the right time to invest. For the first 2 years, Jake does not invest a single dollar. He watches the market every day. He reads headlines. Market at all-time high? Is a crash coming? Experts warn of recession ahead. Is now a good time to buy? Jake keeps waiting for the perfect moment to jump in. The perfect moment never comes. While Jake waits, his $400 a month sits in a savings account earning 0.5% interest. Over 24 months, that is $9,600 saved. At 0.5% interest, he earns roughly $48. If he had invested that same $9,600 into a total stock market index fund averaging 9% annually, it would have grown to approximately $11,400. Jake lost $1,352 in potential growth, not because the market crashed, because he waited. What Jake learned: time in the market always beats timing the market. Every month you wait is a month compounding is not working for you. The best time to invest was yesterday. The second best time is today. Mistake 2. Checking his portfolio. Every single day. When Jake finally invests, he makes a new mistake. He checks his portfolio every morning before work, every afternoon during lunch, every evening before bed. Day 1, up 1.2%. Jake feels like a genius. Day 4, down 3.1%. Jake feels sick. Day 9, down another 2%. Jake panics and sells. The market recovers 2 weeks later. Jake buys back in at a higher price than he sold. He has just bought high and sold low, the single most expensive mistake an investor can make. Studies show that investors who check their portfolios daily earn significantly lower returns than those who check monthly or quarterly. Not because the market treats them differently, because emotions are expensive. What Jake learned: set your investments, walk away, check your portfolio once a month at most. The news is designed to make you feel like you need to act. You almost never do. Mistake 3. Picking individual stocks. After losing money panic selling, Jake decides he just needs to pick better stocks. He spends hours researching companies. He buys shares in 3 tech companies he believes in. Month 1, one stock is up 18%. Jake is thrilled. Month 3, that same stock drops 31% after a bad earnings report. Jake holds on, hoping it recovers. It takes 2 years to get back to where it started. Meanwhile, the total stock market index fund he ignored grew 19% in that same period. Here's the truth about individual stock picking. Over a 15-year period, approximately 92% of actively managed funds and individual stock portfolios fail to beat a simple index fund. 92%. Jake was competing against professional fund managers with teams of analysts, decades of experience, and billions in resources, and even they lose most of the time. What Jake learned: stop trying to beat the market, own the market. A total stock market index fund gives you a small piece of every major company simultaneously. When one company fails, the other 3,999 keep growing. Mistake 4. Ignoring fees and expense ratios. Jake finally switches to index funds. He feels smart, but he picks the wrong index fund. He chooses one with an expense ratio of 1.2% per year because it has a fancier name and a slicker website. The alternative, a basic Vanguard or Fidelity Total Market Index fund, has an expense ratio of 0.03% per year. Jake thinks 1.2% sounds tiny. Over 30 years on a $50,000 portfolio growing at 9% annually, that 1.2% fee costs him approximately $140,000 in lost returns. $140,000. Gone to fees. Not to his retirement, not to his family, to a fund manager who barely beat the market. What Jake learned, always check the expense ratio before investing. Anything above 0.2% deserves a very good reason. The best index funds charge 0.03% or less. Fees are silent killers. They never show up as a line item. They just quietly shrink your future. Mistake 5. Investing without an emergency fund. In month 8 of investing, Jake's car breaks down. Repair bill, pattern $2,800. Jake does not have cash savings outside his investment account, so he sells $3,000 worth of index fund shares to cover it. The problem? The market is down 12% that month. Jake sells at a loss. He pays a short-term capital gains tax on top of it, and he loses the future compounding on that $3,000 forever. What should have been a minor inconvenience becomes a permanent dent in his wealth. This is one of the most common investing mistakes nobody talks about. Investing before building an emergency fund is like building a house on sand. One unexpected expense forces you to crack open your investments at the worst possible time. What Jake learned, before investing a single dollar, build 3 to 6 months of expenses in a high-yield savings account. That is your financial foundation. Without it, every investment you make is one emergency away from being liquidated. Jake's turnaround. At 30 years old, Jake finally gets it right. He builds a $12,000 emergency fund first. He sets up automatic monthly investments into a low-cost total stock market index fund with a 0.03% expense ratio. He stops checking his portfolio daily. He stops reading financial headlines designed to scare him. He stops trying to time the market. He just invests consistently every single month and walks away. By 40, just 10 years later, his portfolio is sitting at approximately $98,000. Not because he got lucky, not because he picked the right stock, because he stopped making the mistakes that were quietly costing him everything. What you should do. Here is your action plan starting today. 1. Build your emergency fund first. 3 to 6 months of expenses in a high-yield savings account. 2. Automate your investments. Set a fixed amount every month and do not touch it. 3. Invest in low-cost index funds. Total market. Expense ratio under 0.2%. 4. Stop checking daily. Monthly at most. 5. Never try to time the market. Time in the market is what builds wealth. That is it. No complexity. No hot stock tips. No perfect moment. Just 5 simple rules Jake wished someone had told him at 25. Jake lost years and thousands of dollars making mistakes that felt smart at the time. He's not unique. Most people make every single one of these mistakes and never find out until it is too late. Now you know. The next move is yours. If this breakdown helped you, subscribe and share it with someone who is just starting to invest. This is the video nobody showed them on day 1. This channel is trying to fix that.